What's up, Outliers? Happy Saturday. So, as you guys have likely noticed, Friday, we have a new podcast that launched. This is kind of like the first full episode with Chris and I. It's called The Options Trench. Super fun. Really just he and I bullshitting about options and markets. And we actually spent a while talking about this exact thing, what's going on topically. Because the broad world right now is fascinating. And there are a ton of opportunities, which is exactly what I want to talk about today. I want to specifically explore some of the ways to conceptually think about what's going on in the world and how you might find tradable ideas from it. Now, a couple key admin notes. One of them is war is really ugly. And in my view and in my lens, it's not really something that I would glorify or anything to look forward to, but it's happening. Doesn't matter what we want, it's a thing. And because of that, I have absolutely no qualm with leveraging opportunities as they exist to make money. The reason why I'm talking about this is because I actually got a couple emails from that podcast and people are asking, they weren't accusatory or anything. They were genuinely just asking like, hey, like, how do you morally and mentally think about the idea of profiting from something like war? And I think it's an interesting question, and it really does get to kind of a philosophical level, but the synopsis of it is whether or not I participate on my end as a speculator has quite literally zero bearing on the conflict itself, whether or not the conflict is going to happen, is going to end. I have quite literally zero say in any of it. And moreover than all of that, it doesn't really directly connect to anything that I'm doing on a day-to-day basis. So you could think about it however you want, but if you're the kind of person that looks at something like war and you say, well, how do I feel about participating, indirectly by trading it? And if you apply that same kind of methodology throughout your life, you're going to find a lot of gaps in how you apply that versus how you don't apply that. So, for example, if you drive any sort of vehicle on any sort of public road, you are indirectly still participating yourself and so on and so forth, right? It just kind of depends on how far you take it. So in my world, the opportunity's there regardless of whether I participate or not. It's way better for me to participate and do something with it. So that's how I approach stuff like this. With where we're at, there's really a lot of ways we can look at this. And I want to talk about a few of them. On the pro side, we've been spending kind of a decent amount of time talking about, starting from last weekend, we did an impromptu stream for the Pro Plus members to trade futures open because that was the start of the first opportunity to trade futures with it. And it's continued since. So I want to talk about a few of those. What's up, Lauren? Kirk, Mark says, when's that birthday? Mine already passed, brother. It's pretty early in the month, but we just hit the good old 35. Kirk says, great podcast. Yeah, I'm glad you enjoyed it. I like Chris a lot, man. He's just a really nice guy, and he's really smart. I'm very excited because the other big thing that I found, and I've talked to you guys about this kind of ad nauseum really, is how fucking difficult it is to find genuinely good people in our space. It's really actually kind of annoying because in the military, it's different. Like most of my friends in the military, I inherently know most of those dudes are just good dudes. They're there for the right reasons. And most people that I come across in the military fall into that bucket. But it's like in trading, it's the inverse. Most people I find in the trading space are kind of not good. And you have to sift through a lot in order to find good people. And Chris is genuinely one of those good people. So I'm really excited to do this podcast with him. So it'll be every single week. Kirk says polymarket options, market arbitrage is fascinating. Fine. It's interesting. You should also check out Benjamin's new video. He and I have been talking. Let me pull it up really quick. It's sad for him, but it's important for you guys. So here's Ben's new video. I'll give you guys a link to it here, which you should check out. The reason why this ties Kirk to the comment is Ben was running cross-exchange arbitrage on prediction markets. So he was using stuff like Polymarket and Kalshi. And he actually goes through a little bit of like what exactly he was doing in these instances and how the idea of cross-exchange arbitrage operates, which is cool. But the underpinning of the video is he blew up, which we never like to see. It's kind of part of the process, but this is a good watch if you're interested in kind of like the prediction market side of stuff. The prediction markets right now, they're just the fucking Wild West. That's what it boils down to. Like there's a little bit of capital in them. And when I say a little bit, we're still talking millions in the liquid markets, but in the grand scheme of things, that's like genuinely peanuts, especially for a lot of these larger entities, complete peanuts. So good video, worth a watch, but yeah, a little bit of trickery with them old prediction markets. Hey, what's up, James? Hey, James, good to see you, dude. It's been a while since I've come across you. Glad to see you around. First thing, let's get an update. I haven't looked at this yet, and I've talked to you guys about this before. I will continually remind you guys, you have to be really careful where you source your news. CNN, we already know, is super skewed to the left, just as Fox is super skewed to the right. I use CNN specifically because I like the way that they do a timeline of shit. It's actually really convenient to read and see how the thing unfolds. So there's a couple other news providers that do this. This is just the first one that I clicked on. I just give you that context because it's not like I'm endorsing CNN in any way. I wouldn't endorse any significant leading news agency at all. And it's just because you immediately know that you can't fucking trust what you're reading. But the broad timeline will hold all the same. So let's see. We'll start at the, whoa, what does this thing do? What's catch up? I haven't seen this one. Okay. Well, let's see. Trump signaled attacks on Iran will intensify this weekend. Series of major explosions in Tehran. Late Saturday, Israel launched new strikes. Trump must pay the price for war. That's from Iran's top security. The Gulf states. So the president apologized for attacks in neighboring nations on Saturday, but Tehran vowed to continue striking U.S. targets in the region. Fresh blasts shook parts of Bahrain, Qatar, UAE, and including the Marina district in Dubai. What's happening here, and for those that don't know what this is, Iran they're kind of blasting just about everybody. Azerbaijan was on the hit list, and they're not really doing a whole lot. There's also a massive, massive breakthrough. This is one of the first times we've seen this in any sort of contemporary conflict, where there's literally servers of big US-based technological companies that are literally being targeted. So now we have things like AWS servers that are literally being targeted. And if you think of it from a tactical perspective, it makes a lot of fucking sense because that will cause a shit ton of disruption. But we have this really weird thing now where it's almost like, who knows? You might have like Amazon starting to hire private contractors like fucking Blackwater-esque companies to protect their shit. And then we're one more step closer to the cyberpunk world of militarized corporations, and shit gets fucking weird from there. Obviously, partially in jest, but the main thing is that is a big break. The fact that we had that happen is new, and that's a very interesting change in terms of the way that war is set to be waged. Let's continue. So there's 6 service members that were waiting. Okay, so Trump visited in Delaware. Okay, so they're back. He said they cast blame on Tehran for the strike on an Iranian elementary school that killed 168 kids, 14 teachers. This is contradicting analysis by CNN and experts suggesting U.S. military was likely responsible. This is why war is not to be glorified. War fucking sucks. And the thing with stuff like this is Iran doesn't want to bomb schools. The US doesn't want to bomb schools. Nobody wants to fucking bomb schools. Nobody has anything out for the kids. But war is indiscriminate. That's also why we had 2 friendly jets fucking shot down. War is ugly. And this is exactly why it's not to be glorified. Shit like this sucks. 168 kids gone. Like, that's awful. I fucking hate to see shit like that. It's part of the business. It's a very unfortunate part of the business, but the business of war is fucking ugly. All right, let's continue. Gulf nations report strikes ongoing into Sunday morning. Kuwaiti army said there is a wave of hostile drones targeting fuel storage. The army said it's intercepting drones over Kuwaiti skies, shrapnel debris. Saudi Arabia's Ministry of Defense said it endured drone attacks, intercepting 21 of them. So one of the interesting things here is that Iran is kind of going after a lot of things at once. And there's a method to the madness, but this is a really difficult way for them to have any sort of sound strategic success, which, believe it or not, in my opinion, is not what they're actually trying to do. What they're trying to do, Trump made one of his terms very clear, which is just an unconditional surrender, which as soon as I heard that, that immediately tells me this fucking war is going on for a while, ladies and gentlemen, a while. If the US wanted to simply go in and wipe everything out, they easily could do that. It would not take that long. And I said that on the Doomberg podcast. It's not that difficult to do. But the thing is, that's not all that's being done here now. There is absolutely undertones of regime change. Regime change massively complicates things. With that as an addition, it's very likely that the conflict that you see is going to continue for some time, because in order for Iran to successfully continue to exist, that's all they need to do. Successfully continue to exist. In terms of tactical objectives, that's not that hard. You just need to play defensively, which they are, and you just need to continue to exist, which you're naturally aligned to do that. That kind of tactical objective, very difficult to execute quickly. So one of the first things that you can keep in the back of your mind as we go through this in terms of volatility in the market and looking for opportunities, this is probably not a flash in the pan. This is something that is likely to go at least for a few more weeks. I would guess 6. And I would be surprised if it goes beyond 6 months, but well on the table, right? I'm saying that right now based on what I know right now. Things can change really, really quick. But based on what I know right now, that's generally what I'm guessing. And a big reason for that is it's of my opinion. And I'm emphasizing of my opinion. This is not fact. But from what I've seen so far, it does seem like if an Iranian leader, a supreme leader, is brought into power, that Trump and whoever else, in Trump's cabinet effectively is making the decisions. It's generally a collective. But if it's somebody that the Trump administration backs and co-signs, that will lead to a pretty quick end. The problem is, so far, that hasn't happened. And that's exactly why every single time you see the leaders meeting, they're being wiped off the face of the earth. That is a ipso facto, I do not condone this group or these people to be the leaders. Ergo, they're gone. That's difficult to eventually get somebody in power, because it makes it harder for them to find people to put in power. But I do believe that if somebody is starting to proxy for power that looks plausible, then there's a good chance, again, if it's co-signed by Trump, that the war would come to a pretty swift conclusion. So that's like the main thing that I see going on here, because the Kurds are also still trying to find their way in, and they would love nothing more to exert control. So there's definitely people interested. There's enough interested parties. The trick here from a trading lens is trying to tease out what themes are likely to exist and grow over the duration of this thing that's more likely than not set to last at least for a few weeks. The other thing with this being, again, at least a few weeks, is the munitions spend over that time frame, especially because this is primarily an air war, is profound, absolutely profound. So that should intuitively give you some direct ideas. And we talked about some of these in the podcast yesterday. You can absolutely find clear opportunities in the defense sector. We talked about some specific names yesterday. And tomorrow I have a small watch list of stuff that I want to review in the market prep stream to continue tracking them down. Now, the way that I'm trading defensive names is a little bit different though. So for example, which by the way, the airlines have been taken out to the fucking woodshed. And this is a whole other conversation. I was doing a bunch of research on the airlines earlier. But if we look across the defense sector, let me find like a defense sector F, and then I want like the specific hold. So I'm looking at the holdings of ITA. There's 45 of them. And I'm going to sort it by weight. And I mean, like the top grouping is the bulk. It gets down into like the sub 2% pretty fast. So the top is GE. Notice GE's price behavior. I just want you to pay attention to these charts as I flip through them. Just let your mind see whatever it sees. There's no rules. There's nothing that you have to see, you don't have to see. Just see what sticks out to you. So here's GE. This is 20% of ITA, which is the iShares Aerospace and Defense ETF. Next is RTX. Next is Boeing. Next is Lockheed Martin. Next is Northrop Grumman. I'm going to skip Howmet. I'm going to go to L3 Harris. Notice how similar this chart looks like to another one that you saw already. Pretty fucking similar. The next thing, General Dynamics. Rocket Lab is in here. And then another one that's not in here that I think should get an honorable mention is Honeywell. There's a really big gap between who is participating and who is not participating. This tells you a lot about their underlying business and their involvement in the current conflict and their expected involvement in the current conflict. Key details to keep in the back of your mind. Some of these things have already had quite profound moves on relatively short time frames. So for example, if we go back to Raytheon, they're up 3.5% over essentially a week. So some of these things are having decent sized moves already. And this is where you need to be pretty specific with your playbook in terms of what's gone too far and is likely to reverse and, things like that. But the first takeaway that I want to show you from looking at these defensive names is the fact that there's a massive breakdown in participation. There are very, very clear leaders and laggards. That's one of the underpinning methods that I use to find things to trade both to the upside and the downside. Okay. So let's continue reading through and see what else is going on. I don't care about them. Ground troops could possibly be sent to Iran, but require a very good reason. This is an interesting dialogue. This goes really deep. My expectation on this is that if they do go, it would likely be in a very limited capacity, like likely different kinds of special forces units. And we're already doing a lot of special forces units implementation in places like fucking Ecuador right now, which is actually, in case you didn't know, that's a big narco state now. Ecuador has been pimped out over the last like 5 to 8 years because of their shipping lanes, and they started being integrated into a lot of movement of illicit substances. So the U.S. has special forces literally in Ecuador right now operating with the Ecuadorian police and military. Don't care about this. Don't care about this. Don't care about this. So there's also a lot of activity going on in Iraq. For those that don't know, let's see. 2 explosive-laden drones shot down over the Kurdish city of Erbil. Drones were shot down at 11 p.m. Drones were intercepted. Debris fell in a residential neighborhood. Iran and Iran-aligned militias in Iraq have targeted the U.S. consulate and the American base near the airport. Yep. Israel strikes oil storage sites in next phase of war. This is important. This is really important. So I was literally about to say Israel. Israel begun striking oil storage sites in Iran as part of the next phase of the war. They hit fuel sites in Tehran, which, for those that don't know, what's happening right now is China is the largest consumer of Iranian oil. I think. I emphasize, I think. If not, they're very close, but I think they're the largest consumer. There's nobody more than China that wants this thing to be over and be over quickly. That's exactly what they want. So they have an envoy trying to mediate some of this. But it's very similar. What's going to happen with Iran, China, and the US is very similar. What's going on between Russia, Ukraine, and the US, where it's the US hasn't forcibly stopped Russia. We've indirectly helped the opposition tremendously, just as Russia is beginning to do now with Iran and providing them intelligence and target data. But what I'm emphasizing here is it's very difficult for these superpowers to bully another superpower. And it's for the exact reasons that you know of. It's much easier for Russia to pick on Ukraine, for the US to pick on Iran, than it is for Russia and the US to start going at it, or for China in the US, or some variation thereof. What I'm emphasizing here is now that we're getting into Iranian oil, which is a massive source for China, this creates a significant problem for China. And the issue becomes even more dire the longer that this goes on. So this is now up for grabs. If this continues to a significant degree, you're likely going to see China becoming more and more involved. Again, as I go through this storyline talking about what we see in the article, your brain shouldn't be listening to the story. Your brain should be listening to what is the idea? What's the tradable idea here? And there's a lot of them. What's going to just think of basic supply and demand rules. Right now, global demand for oil is whatever it is. This has not changed. If anything, it's gone up slightly just based on the war itself. So demand, let's just call it about the same, if not slightly higher. Supply is getting fucked. Supply is being punished. Not only is it the movement of oil through things like the Strait of Hormuz and other canalization regions, but this actually hitting production in refining, that suppresses supply even more. So what does that equal? We now will have demand steadily expanding and increasing oversupply. What are some of the things that we can expect to see? And we already saw this. UAE has already come online talking about trying to increase their production. OPEC Plus is talking about increasing production, but they're not going to be able to cover this gap as much. So there's two questions you have to ask yourself, which is, how bad do I think this disruption to supply is going to be? And there's a top line idea based on that alone, which is movement of the price of oil. Another thing that you have to be super thoughtful of, and a lot of people are honestly not that super thoughtful of, are the different oil instruments that exist against the different kinds of oil that is produced and utilized. So for example, if you said, oh, damn, I think, with Iran getting hit, Iranian oil is going to go up. Well, here's the problem. If you're using something like CL/CL, that's light, sweet, crude oil. It is different than Iranian oil. The reason why this matters is because the infrastructure that different entities build around have to do with what the inputs are. They're not set in stone. You can absolutely tailor refineries to handle different ranges of inputs, but that also requires changes and investments. The kind of disruption that happens is not just in the top line barrels of oil move, but it's also the types of oil and where do those types of oil get consumed, and then which one of them are being hit harder than others. Are there viable alternatives to come online? You saw this in the US. The US imports a lot of heavy oils from places like Canada, and a lot of US machinery needs heavy oils. However, there are ways for the US manufacturing systems to reconfigure for different kinds of oil if need be. But it's not a simple process, it's cost intensive. So there's a barrier to making that switch that includes cost that has to be accounted for. So if we think then on a first order thought, and we say to ourselves, let's take a look at how much oil and what kind does Tehran oil refinery use, and who are its primary consumers? I have GPT in thinking mode, so it's going to be a little bit slower, but looks like Israel is now targeting Hezbollah leaders in a strike on Beirut. Fucking everybody's getting it, man. Damn. Brutal. Okay, so the Tehran's oil refining companies, it processes about 250 barrels of crude per day. Its feedstock is listed as Iranian light crude and crude from Arun Shadagan. Main refined products of the Niordic, NIORDC refinery profile, and it's giving me specific details of like what the profile is. A newer 2025 report says the refinery produces 6.5 million liters per day of gasoline and 14 million liters a day of diesel. The primary consumer, so it's the Tehran province alone consumes about 22 million liters a day of gasoline in 2024. So a lot of it is going to be local. Okay. So the Tehran refinery is mainly a domestic fuels refinery and not a major export-oriented one, which is really informative. Its biggest economic consumers are Tehran area gasoline users first, domestic diesel users second, and aviation, other local fuels after that. So that itself seems still like we're not necessarily crossing too far into that relationship that I was explaining with China. So I belay some of what I said because this refinery specifically doesn't seem to be a primary exporter. The general sentiment of what I'm talking about obviously still holds, but this instance doesn't. Trump wants to be involved in Iran, in picking Iran's leader, doesn't want to come back every 10 years. We don't want to come back every 5 or 10 years and do this. We want to pick a president that's not going to be leading their country into war. Okay. He rules out the help of Kurdish forces in the war. Give that time. This is the dignified transfer of the troops. And the UK is starting to get involved. This I don't know the details of in terms of who did it. To me, honestly, it really doesn't matter who did it directly. It is awful and everybody's to blame. Like quite literally everybody's to blame. So, yeah. I don't care about this. We don't care about this. Don't care about this. All right, let's see what the headlines were from yesterday, and then we'll go through some other stuff quickly. We already talked about this. Trump administration declared an emergency, bypassed Congress to immediately sell 12,000 bombs to Israel. So production, right? Defensive production is going absolutely haywire. The new leader, we already know, is they're still trying to figure that out. So the US hit a desalination plant. This now also starts to become a humanitarian issue. So not getting access to clean water is no good. Kuwait cut oil production. And some more attacks in Iraq. And it looks like otherwise we're still just doing the fucking thing. Standard Americans, of all the things to be concerned about, this is the top line. And I don't want to say that dismissively because I really do remember not having money and how incremental changes in the price of gas really do suck. So I'm empathetic towards that. But it's also hard to take this kind of stuff super seriously when there's just people getting fucking murdered. So I get it, but a little self-centered, but standard American. That's how we do. Okay. Any questions, any other headlines that you feel like we should take a look at quickly with respect to the conflict, anything like that? Zuber says, puts on airlines. It's not a bad place, to be honest. I was literally talking a little bit earlier about airlines. I was specifically analyzing cross industry. So I was looking at like UAL, I was looking at Love, AAL, and these are all getting absolutely smashed. But the skew and the volatility surface is actually quite fascinating in these. There's a lot that can be done. The cliff notes for pretty much all of those, though, is that you have to be really thoughtful about what you're doing and how you do it, because volatility is probably not going to behave the way that you intuitively think it might. And I know that that's kind of like an obscure series of open-ended comments, but what I'm specifically emphasizing here is if we first just take a look at term structure and we see, actually it'll be more visual here. We'll do the out of the money and let's just do a couple series. So the first thing is you can see that these front series, in this case, 20 March, notice how haywire a lot of this curve is. This happens during different periods of distortion when people are bidding up vols at different levels and specifically trying to pounce on individual strikes. And if we go into AAL and we take a closer look at things like the smile and skew, first, you can see term structure has flips between contango and backwardation, which in general is just absolutely, this is abnormal. But with times like this, what's happening is you are fully expecting volatility in the front. Now, how far that volatility trickles out is actually a good proxy for how long people are expecting the conflict to go on for. But right now it's generally unknown, and you can see that it's broadly not really agreed upon. The other thing that I notice is the equidistant out of the money. So one of the things that I don't like about this plot is that it uses just strike. A really good version of this kind of thing, in case you don't know, is normalizing by delta and plotting them over the same thing. That's what I do in Python. It's a much better visual, in my opinion. And it helps you see what this is trying to show you, but at least for me, a little bit more clearly. Because in this case, you have to look over here for, it's just like an options chain, right? You find the out of the money calls here and then the out of the money puts here. But you can look at the relative relationship between these. And if I look at, let's say, what spot is at 10. So if I go $3, what is it, 6? If I go $5 out of the money on the put side, we can see that vol there is like 1.4. So 144%. Just ignore the calls. Those are in the money. And then if we go $6 this way, that puts us on the call side at 97%. So you're not actually seeing huge put skew coming online just yet. And there's likely a litany of reasons for that. So here, this is a 42, 43 delta put. It's a 66.6% vol. And then this one's a 42%, and this is at 65%. So about the money, meaning right out of the money, you're actually seeing a tiny itty bitty bit of put skew, but not much, not as much as you otherwise might expect to see. So what all this means is the way that you choose to play it really, really matters. But what's happening, and broadly happening, is people are betting to the downside, like pretty significantly. And you can see it, right? Like take a look here. The change in open interest it grew by 20,000 contracts. Right. So it's a massive, massive, massive growth here. That kind of stuff tells you where people are seeing and pricing risk. But the other thing that you'll see is like the out of the money calls, they're all fucked. Like the slope of these changes isn't as steep as you might expect it to be. And then the put side, I don't think is actually quite steep enough yet. It's steep, but I don't think it's actually steep enough. But you can also see the market's pricing in a floor. It's, pricing in a floor like 8, 7, 8, something like that. So the market is not expecting the airlines to have a huge, huge drop from here. So all of the movements that you see in terms of vol in some of these assets is where I think some of the bigger opportunities are. And it's because the volatility is just really elevated, but some of it is very fairly priced. And this, I will always take this opportunity to remind you guys that if you see volatility is high, that is not your notice to fucking sell. That is not a good idea. What we care a lot about is volatility's relationship to itself, and then meaning the volatility of vol, but then also volatility's relationship to realized vol. You care about both of those actually kind of a lot. And right now, it's really, really difficult to directly tell how well vol is priced. But using something that lags like this, and the reason why this lags is because we need to essentially use data from a month back. That's how we actually see in this kind of context, how did the risk premium play implied versus realized? And you can see it literally started flipping back here on like the 27th, the 23rd or the 27th. So if we eyeball on a chart when that was, that's here. So then the question you might logically ask yourself is, well, do I think that this has gotten better or do I think that this has gotten worse? And this is if you're using a lagging indicator. If you have forward projections, that's all the better. The thing that what I'm emphasizing is that if you use a tool like this, especially for those that have the think script, this isn't lagged. And that's like a really, really important thing to keep in the back of your minds, because the implied vol at a certain point needs to be made relative to the realized vol for that same period. So implied is forward looking, realized is back looking. If I want to see how the 30-day vol pans out, I need to see what happens to price over the next 20 days. That's how I'll know how it panned out. So you need to lag it. Slightly important note if you're using different kind of vol profiles like this. So we've talked a little bit about what's going on, and we've talked a little bit about the defense sector, which I still think is probably a really simple spot to start looking. The other thing that is likely worth taking a look at is something like the fuck is it? I think they're like LNG. Should be Chenier. Yeah, there they are. These guys. So what this is it's like effectively a pure LNG export play. And Qatar is a big supplier of global LNG. And the Qatari output is now down. What that means is, going back to our basics of supply and demand, one of the suppliers of a high global demand item like LNG is suffering. They've come down. This leaves a vacuum. There's space. So a company like Chenier or LNG, they have an opportunity to consume as much of that as possible. So this doesn't mean that it's going to completely replace what's there, but it does mean that the company has a massive opportunity to expand its reach as long as that's the case, which we've already noted is likely going to be for some time. However, remember, the market is fucking smart. This thing hasn't had a 8.7% move over the last week by accident. It's had this move because it knows that. And the question you have to ask yourself is, how well do I think it's priced in? That's the question, which is a tough one. You have to do a decent amount of homework on stuff like that if you're so inclined. But what I'm emphasizing here is alternative energy. Stuff outside of crude, outside of the main conversation, still has a really, really big seat at the table. And we already talked about stuff like Raytheon, which is directly involved in all of the replenishment profiles of drones, missiles. They have a lot of integrations with other suppliers that would participate as well, like Boeing and whatnot. But there's also direct oil-based plays that you can look at. So things like ExxonMobil. But if you'll notice, there's a really curious relationship here between ExxonMobil and, let's just plot something like crude oil. Real interesting. This tells you, again, about the relationship between these and how something like ExxonMobil does or doesn't fit into this. The general theme here is that the market itself likely has already done a pretty good job of pricing who it thinks is going to be stepping into the demand vacuum. But that what I'm emphasizing is that that picture is going to continue to change as the conflict evolves. So there's still opportunities here. So they're worth watching. Chevron, notice a slightly different profile. Again, informative. One of the things that Chevron has is, for those that don't know, the footprints and the logistical cycles for ExxonMobil and Chevron are actually they're pretty similar in a lot of ways, but their main sources of revenue do differ kind of a lot. And that's why you see Chevron operating almost inverse to what you see ExxonMobil. ExxonMobil had a really strong initial reaction that then faded. And Chevron is the opposite. It had a decently strong initial reaction, but that's been a little bit more consistent. And then you can also play shipping ideas. So anything, like in DHT, shipping is a big part of this equation. And right now with the Strait of Hormuz where it is, that just makes it a little more difficult. I don't like plays like this myself. This is not where I would go personally. This is, however, a place that when the conflict eventually is resolved, then this gets really interesting because this is going to have to get repriced pretty damn fast, which leads to one more point that I want to make, which is I'm showing you a lot of big names. And the reason why I'm showing you a lot of big names is because these are what's liquid, they're well-known and stuff like that. But as an enterprising smaller trader, a lot of the really cool opportunities are not in the big names. A lot of the really cool opportunities are actually in the smaller, not penny stocks. It's not binary. You don't have to be in mega cap or penny stocks. There's a really beautiful middle ground of small caps and mid caps that actually directly play in a lot of this, but with a lot more concentration. And what that means is you're going to see more volatility there. And again, from the lens of a trader, whether you like being long vol or short vol, you need that volatility. That's where all of us make money, regardless of how you choose to make money. That's where it is. So it's absolutely worth taking a look at some of the downstream smaller names that we're not talking about. That's a really, really good idea. It's something that we're actually going to spend a decent amount of time tomorrow doing. And I'll show you like the direct parallel between these, and you'll see how some of them move compared to the others so that you can build a mental model to just look at stuff. And you can say things like, well, if the large caps are moving this much, then probably the smaller, more direct plays on average are moving, 1.7 times this or, whatever it is. Super random number, but it'll be highly dependent on the business. All right. Any questions? Anything that you guys think that we should hit before we wrap? What do you guys think? Javier says, mental models, I'm triggered in a good way. Hell yeah, that's good. It's those kind of really simple ways of analyzing stuff help a lot with finding opportunities. Because if there's one other piece of advice I could broadly give while we're talking about this is just make sure that you're actually like looking at stuff. What I mean by that is when conflicts like this are going on, when dislocation is like really big and when there's a bunch of random shit going on, what you don't want to do is have your scope so wide that you're kind of like just casually seeing a bunch of shit, but you can't do anything with any of it. Make sure that whatever you choose to do, you can get yourself to a level of depth that you're comfortable operationalizing, because otherwise there's no fucking benefit to any of it. And even if you choose to continue doing whatever your core thing is, then I would say just pick something small. In a conflict like this, conflicts evolve. Conflicts look different, but they always fucking rhyme. They always rhyme. They're not that different. The places where they are, what happens, like all of it is always unique, but a lot of it looks the fucking same. So what that means is even if you're not planning on doing anything directly with what's going on now, it's like really, really easy to build solid models in your brain so that you at least have some intuition on how things might move based on a circumstance. Zuber says, do you think institutions already position themselves before the war? The broad answer is no, I don't think so. But the trick with something like that is retail traders, we use the term institutions like it's this fucking all-being thing. And the reality is like within institutions, there are tons of different players. There's pension funds, hedge funds, mutual funds, ETFs. There's buy side, sell side. There's market making. There's a million different flavors of institutions. So one thing that I would encourage you to think of is not so much in the context of institutions versus any other entity, because that, I think, leads to a series of different mental decisions that are being inferred from that. But we can look at where big money is pretty easily. So we can use things like a COT report, the COT report, and you can eyeball how people are positioned and how they've been positioned. So, for example, if we look at large speculators, which is this green line, large speculators have been effectively net short futures from April of last year. So what I'm emphasizing here is they've not participated in this entire fucking rally on this side of the equation. But it's like the same thing with GEX and DEX and these other bullshit metrics that people are fascinated by and fooled by. We have absolutely no fucking clue what the rest of their book looks like. They might want to specifically be short through some of this because their books lean naturally long and they're trying to trim some deltas and they're happy to eat this. All I'm saying is when you use anything like any of these tools, you cannot let that broader context escape you because you cannot make any sound conclusions from any of these numbers by themselves. But what you can make is good conclusions from extremes and from trends. So the fact that you haven't really seen large speculators long on the future side of stuff for some time now, it immediately tells me that they're not participating in this. They're likely participating this in individual names and then using some of this to lay some risk out. So then we can ask ourselves, well, do we think a bunch of these companies maybe knew something was going to happen ahead of time? And we can fact check it, right? We can see when the conflict started. I think, what was it announced? Like the 26th or something? Does that sound right to you guys? I don't know the exact date when it was announced. It was a weekend, wasn't it? When did the Iran war start? I don't remember. Friday, 28 Feb. And coverage started on 1 March. So if we started to think that there might be a lot of positioning going on, we know that the conflict started on 28 Feb. So we would expect to see a lot of positioning occurring before that. So for example, I look in AAL for the few days leading into that, and I don't see anything that directly sticks out to me. I do see this broad pinch up here, but this doesn't, I don't think that hits the Richter scale. Maybe a little bit, but not a ton. So there's AAL. Let's take a look at Raytheon. Raytheon on, what is this? March 6th. So this is well after the conflict started, but somebody had a pretty fucking good idea. Oh, I'm sorry. This is well before the conflict started, but I think that this was a completely different idea. However, I did talk about this in the live stream, or I'm sorry, in the podcast with Chris, because I've actually been watching to see when these unwind, which they haven't yet. So I actually can't make heads or tails of this one specifically, but this looks like somebody knew some shit. That's what that looks like to me. Then we have LMT. LMT, this is on 27 Feb. This also looks like somebody knew some shit. The fun fact about this one is I participated in this one because this popped up on one of my scans. They literally went from 1130 net call premiums were at 17.9 million, which is already like several standard deviations to the upside. That's at 1130. Then at 12 o'clock, a half hour later, net call premiums went to 270 million, right? How sick is that? So this is the cool part about options markets, is you absolutely can find artifacts of this. But going back to the original question is, do we think institutions position themselves? And no, definitely not. We're talking like a total call premium here coming into this of $291 million. That's less than a big fund. So no, like as we look through these, if we thought that there was a bunch of massive positioning going on, we would expect to see things like just parabolic increases in things like SPX puts, or let's see, which we don't really see. So there's that. In general, I don't think we see it. It's a great question though, Zuber. It's a really interesting question. I spent a lot of time looking at stuff like that because I find it so fucking fascinating. But what I will tell you is this S&P print on Friday, this is not good. The put premiums running up like this, that's not good, by the way. Dark Mark says Oliveira or Holloway. That's a great fucking question. I don't know what the odds are. I don't even want to look at the odds. What are the odds? My instinct would be Oliveira because I think he would try to take it to the ground. And then I think he could beat Holloway there. But the other thing is Holloway has an insane gas tank. Like there's a really good, and he has good grappling. So there's not an insignificant potential for him to try and drag Oliveira out, because Oliveira has quit before in those later rounds, especially in his younger career. So he's made like a really good turnaround, but I still would have to guess Oliveira. I'm actually really, really curious what the odds are. Oliveira, Holloway odds. Holloway's the favorite. Holloway is the negative, what is it? What's he at? 230. And Oliveira's at 175. That's fascinating. I wouldn't expect it to be that different. Maybe, I mean, I haven't seen Oliveira in a while, so maybe he's a little bit, maybe he's just a little bit not active as much. G36 says 3 ads with 5 exclamation points. What ads are you talking about? I literally don't have ads turned on. I'll literally show you. Yeah, I straight up don't have them on. Ads are off. So IDK, what you got going on, bro beans? But let me look at monetization here. Yeah, you got no ads on. The fuck you talking about? And then this is from inside the settings. Right here too. Monetization is on. This is for people that watch the recording. Mid-roll ads, which is what we're in now in the stream, they're set to manual, which means I have to click the button to put ads on, and I don't click the button. Anybody that catches any of the live streams, I literally don't have ads on. I've actually thought about turning them back on though, because it's free. So I don't think it's, but the reason, to be completely straightforward, is the ad revenue for like a live stream is so insignificant. It's just not fucking worth it. But if I was like burnt peanut level, I would fucking run ads for sure. There's no reason to say no to that money. So G36, I would love to hear you explain yourself, brother man, because it looks like you talked about it a couple times. I see 3 ads again, and then I see unnecessary. I have absolutely no idea what you're talking about, Willis. Zuber says there are no ads. Thanks for that. Yeah. I absolutely, yeah. And then 45 says, I don't see any ads. Good. Yeah, you guys shouldn't see any ads. I literally have them turned off. The thing with ads is like I said, the ad revenue that I would get from it is so insignificant, and I don't fucking like ads. It's not until recently, at least, that I even got YouTube Premium. I used to just use like ad blockers and stuff because that's cheap. But yeah, I don't really like them, so I don't fucking turn them on. Let me see. Zuber says, I want to see Holloway point to the ground and both of them sing it out at the end. Yeah, the last 10 seconds. That's always fun. That's super, super fun. MBW says, if you have your phone on landscape mode, it will do ads no matter what. Oh, that's fascinating. But if you do it in landscape mode, it's not inline ads, right? It's not like pausing the stream. They would be something else. MBW says, I took a long put down for a profit, but my hypothesis stands. How do you mentally get back in a trade if it makes sense again? Sometimes I have a win and it feels harder to get back in. That's a great question. So what's happening there is likely the disposition effect, because the reality is, like, if you had a long put, but the hypothesis didn't change, there was no reason to take the trade down. Like, that's the reality. If, let's say that the original trade has run its course and then it was time for you to reposition, then that would just be reestablished immediately. That wouldn't be wait. But part of what you're likely experiencing is what's known as the disposition effect. And it's a really well-documented psychological, I don't want to call it trait, because I think you can train out of it. So maybe it is a psychological trait. But essentially, traders really like to take winning trades down and often do so very quickly because you want to realize the win. And then they don't take losses down quickly enough because they don't want to realize the loss. So the way that I think about trades like that is, let's take a look at an example. DHT. DHT's up. Full disclosure, I don't have a position in here right now. But let's say that I thought, what would I think? Let's say that I think DHT is not going to go below 1775. Just picking a fucking number. Let's say that I think it's going to stay above that. I'm not necessarily super long. I'm not necessarily super short. I just think it's not going to go below this consolidation level. And let's say in that context, I chose to sell a put. And let's say that I sold a put for a week. I probably wouldn't do that. But the reason I'm doing a week is just so that it's a shorter window to make a decision. And let's say if I sold that put, and let's say back here, I thought that. And let's say a week goes by, the underlying is now up here, and I still feel that way. So I'm left with a choice. I can take that week-long put down for a profit, and then I can look at selling a new put. Now, if I sold that new put, I already know I'm not going to get the same return for being way down here at the 17.5 or the 17 handle, because now we're all the way up here. So the question I would ask myself is, well, do I still feel that way up here? And if so, is it now higher? Or do I not feel that great and I think it would be down here? And because of that, the premium that I would collect up here on the short put side is not good enough for me to take the risk if I'm expecting it to stay above this level and I'm not confident up here, I would wait. But another scenario is, let's say that I sold the put here, and let's say it's a 40-day long option. And let's say that it starts to move up, it starts to come back down, but my overall thesis remains the same. There's no change. The position doesn't come off until I hit whatever the predefined management window is for that position. So let's say that there was a premium target, which, by the way, is typically a bad way to do it, but let's just say that there was. If on this day, I happen to come up on a premium target, which, based on my trading plan, that's where I'm supposed to manage this thing. My general idea remains the exact same. There's literally no change. What I would do is take the trade down because I hit my target, and then I would immediately lay out the new one. So that means I'm not going to wait and see how it behaves here. If my hypothesis genuinely is the same, nothing has changed, then I would just continue the trade. So the only reason why I would even come out of it is if there was some sort of like structural reason based on the broader strategy that leads me to come out of it. Otherwise, I would just stay in the trade. A big thing that you want to try to do is you want to decrease how much you're transacting as effectively as you can. And that doesn't mean like go crazy and, not do stuff you need to for the sake of transacting less. That's not it at all. But you do want to decrease how often you're transacting because it just creates more friction. Remember, things like commission and slippage, they're there every single time, whether you have a winning trade or losing trade, agnostically, they're there. So it means that they add up over time, and you want to try to keep those low if possible. So for MBW, the summary for that is if the idea is the same, then the first thing I would double check is why did the trade even come down in the first place? If there was some sort of big structural reason for it to, then completely fine. The next question then is, well, why didn't we immediately reestablish the position if it still fits the portfolio and if our hypothesis is still the same and we still like the idea? My instinct is that part of it is the disposition effect, that we saw a trade that was in profit. We wanted to realize the profit, so we took it, but then we're sat thinking, I think there might be more, which is a fair idea. But that's something that you kind of have to train out of yourself. And one of the things that comes with training that out of yourself is getting used to seeing stuff that was in profit that becomes not in profit. And that's just part of it. It's no big deal because any one individual trade genuinely doesn't really matter. It's overwhelmingly about the aggregate of what we do. So that's how I would think about it. I would question why it came out first, find a good answer for that. And then if all other conditions remain solid, then there's no reason not to re-enter. Another one that's really tricky for people, I think, especially from like a breakout approach, is there's a lot of whipsaw, and that whipsaw can be super annoying. But again, we've reviewed this on a bunch of like the pro live streams where we kind of like go into detail on the individual trades. And they've heard me talk many a time about being in something, getting kicked out, getting back in, getting kicked out, getting back in. And that's just part of the timing. So for example, let's say that I was trading a breakout. This is not a good example actually, because that's a fucking lean ass breakout. Let's find something else. Yeah, okay, great. This is a good example. Let's say for whatever reason, when Tesla broke above this, that I wanted to get long for whatever reason. And it starts to run up and it starts to cross below some short-term moving averages. Let's just say for whatever reason, I thought it was going to close down here, so I got out. And the next day it opened up above where I was. I would happily and willingly get directly back in. Regardless if this trade here came down at a loss or not, if my general idea remains the same and it starts behaving correctly the next day, I immediately get back in. And it's because it's not about like the realized P&L before, it's about getting me in front of good opportunities and good trades. And that's all this is. So like the next layer to overcoming the disposition effect is actually desensitizing yourself to coming in and out of trades and just focusing on an opportunity. So like my decision to get back in this example on this day would have nothing to do if I made money up until this point or not. It's completely agnostic to that. It's, do I think that the thing that I was trading in the beginning continues to exist? And if yes, then yes, I will make the trade. If no, then no. Then it's time for me to get out and go do something else. So it's more like a conditions-based environment rather than worrying about P&L of individual positions. The prior P&L doesn't matter at all. That's on a prior sample, and now we're on to a new sample. 45 days says, have you ever thought about switching to a low-fee brokerage like Webull? No. I've looked at them before. I've already negotiated my rates pretty aggressively with larger brokerages, and I just, maybe it's me in my boomer status or becoming an unk, but I don't see any direct benefit to me moving to a smaller discount broker. One of the things that you guys should look at, and I think it might be on SSRN, let me find it. I'm looking. I need to find something for you guys. So you guys should look at this. You guys should look at this. And then there's another one I have to find for you guys really quick. I'm asking Gemini to help me find it in my here we go. Here you go. Here you go. So you need to look at a few things. This is a good one. This is another thing you need to look at. So I'm not affiliated with S3 in any capacity, but there's different filing requirements for brokers. So there's SEC Rule 605, which is execution quality reports, and then there's 606, which is broker order routing reports. Essentially, what you can do is you can read these and learn about the execution quality from your brokers. So for example, a place like Robinhood. Robinhood was seen as no commission options, cheaper than the others, quite literally more expensive than places that had flatline commissions and better order routing. And it has everything to do with payment for order flow and bundling of orders. So the only thing that places like that are doing are decreasing access, making it really convenient. And then they're just leaning on that and that specific constituent. For like bigger traders and people that are doing this more at a professional scale, you're not going to see any of us in anything like that. Actually, you're going to see most of us in things like IBKR. Schwab is actually a little bit more of a niche thing, and it's because I started there. IBKR is kind of like a standard for a lot of places, and IBKR is good. The fund that I advise at, they go through there, and IBKR is fine. I've been getting more and more used to the Trader Workstation. So yeah, IBKR is really standard. The other thing is in bigger brokers, you can choose how you route your orders and shit like that. So yeah, this kind of stuff is actually important to take a look at, I believe. And there's a lot of really, really good detail and reports. This company is one that looks at it. Let me see if I can find an actual report example. Let me find it. Let's see. So here's one. I'll throw this in the Discord for you guys. And then this is the other one that I'm thinking of. Here. And then I'll throw both of these in the Discord for you guys. First one, second one, third one, and here. Sweet. All right, gang. I am out of here. Enjoy the rest of your nights, pro members. I'll see you tomorrow for market prep. Be an outlier. See y'all later.